Having a good credit score is essential for getting approval on loans and credit cards with the best terms. But what exactly does that three-digit number say about you and your financial trustworthiness? Well, in this video, we'll demystify credit scores, what they are, what goes into calculating them, and most importantly, tips and strategies for understanding and boosting your score. Whether you're trying to improve a poor score or maintain an already good one, this video will crack the credit code so you can leverage it to open more financial doors. Well, we've all heard about the importance of having a high credit score. But what exactly is a credit score, and why does it matter so much? A credit score is a three-digit number that gives lenders a snapshot of your creditworthiness, conveying your financial reputation by indicating how reliably you have paid debts in the past. Scores typically range from 300 to 850, with below 580 considered poor credit and 670 and above representing good to excellent credit. So why is your credit score so influential? Well, lenders refer to credit scores to predict the likelihood that you'll be able to meet your financial obligations and pay back money you borrow. If you have a high credit score, it sends a signal to lenders that you are lower risk and can handle taking on debt responsibly. Conversely, a lower score conveys higher risk, making lenders less likely to approve you for new credit. Understanding your credit score gives you power over your financial options. Keeping tabs on your score and taking steps to boost it will expand your access to the best rates on mortgages, car loans, business loans, and more. Your credit score is calculated using the FICO model, based on information in your credit report. What are the key factors making up your score? There are 5 main factors that hold different weights. Payment history has the greatest impact, comprising 35% of your FICO score. Each time you do or do not make payments as agreed, it is reported and appears in your payment record. Paying late, missing payments, or defaulting on loans can seriously ding your score. Your history signals risk to lenders, so to keep your score healthy, pay all monthly bills including utilities and cell phone on time. The second biggest factor is credit utilization at 30% of your score calculation. Utilization measures how much of your total credit limit you are using across accounts. Maxing out cards signals financial risk, while keeping balances under 30% of limits shows responsible usage. To lower credit utilization, pay off cards with the highest balances first. Ask lenders to increase your credit limits and use cards lightly while paying in full monthly. At 15%, length of credit history relates to how long your track record of using credit has been established. In general, the longer your history, the higher your score. Closing old, inactive cards or loans can actually hurt your score. To leverage a long history responsibly, keep long-standing accounts open to help raise the average age of accounts. Also, hang on to installment loans like student, auto, or personal loans until they are fully paid off. Credit mix contributes 10% based on your mix of loan types and credit cards reported. Having both installment loans paid over fixed periods plus open revolving credit card accounts can strengthen your diversity of credit types. Ways to increase responsible mix include charging recurring expenses to a credit card paid off every month and choosing installment loans over credit cards alone when financing larger purchases. The final 10% relates to new credit inquiries when applying for new credit, as each inquiry can ding your score a few points temporarily before rebounding within a few months. Too many inquiries in a short time frame signal risk and impact chances for approval. To manage inquiries responsibly, only apply for credit reasonably needed at the moment, limit applications to 1 to 2 per year, and comparison shop rates within a focused 2-week period. Monitoring all the factors composing your credit score provides focus regarding where to direct efforts to build your score over time. Now that we understand key ingredients impacting credit, how do they get boiled down into that single influential 3-digit score? FICO created the most commonly used credit scoring model, used by 90% of top lenders. The FICO formula gives different weights to those 5 factors. Payment history accounts for a substantial 35% piece of your total score. Credit utilization holds the second largest share at 30%, followed by length of credit history at 15%. Credit mix contributes 10%, and new credit inquiries make up the final 10%. When applying for credit, lenders pull your credit reports and plug the data into FICO's formula to analyze risk and generate a score from 300 indicating poor credit up to the pinnacle score of 850. In general, scores fall into ranges as follows. 800 to 850 equals excellent credit. 740 to 799 equals very good. 670 to 739 equals good credit. 580 to 669 equals fair credit below. 580 equals poor credit. Tracking your FICO or Vantage credit scores from all three credit bureaus allows you to monitor changes and catch inaccuracies early. Reviewing your scores frequently provides insight into how your financial behaviors influence your influential credit number. Understanding the FICO calculation empowers you to direct efforts toward factors carrying the most weight in building your credit worthiness over time. Now that we understand key influencing factors, what practical steps can we take to strengthen our scores? Firstly, check credit reports regularly from all three bureaus at least annually for errors or outdated information dragging your score down. Dispute any identified inaccuracies by submitting documentation to get mistakes corrected promptly. Pay all monthly bills and debts before the respective due dates to nurture positive on-time payment patterns. Automate recurring payments or set payment reminders if necessary to avoid late slips. Pay more than minimums on credit cards and loans whenever possible. Keep credit card balances below 30% of the credit limit on each card every month. Give priority to paying off cards with the highest balances first while making minimum payments on other cards. If possible, pay off cards completely each billing cycle to avoid accumulating interest charges. Be prudent regarding new credit inquiries when shopping for fresh credit, as each application can result in a hard inquiry temporarily depressing your score a few points. Only apply for reasonably needed credit and avoid unnecessary application sprees. If money ever gets tight, call providers to negotiate alternative payment arrangements or settlement offers. Getting collection accounts settled or paid off can help improve your score over time. Finally, be patient and persistent. Credit scores respond gradually to changes in financial habits, so employ responsible money management tips consistently and your score will rise. If financial struggles have damaged your credit, here are some practical rebuilding tips. Firstly, prioritize paying down credit card balances since heavy balances negatively impact your credit utilization ratio, a primary scoring factor. If needed, contact issuers to close unused cards temporarily until balances are paid. Next, negotiate payment arrangements on past due debts, offering realistic payment plans given your situation while documenting progress making payments as agreed. Limit new credit applications to preserve inquiries while rebuilding score. After approximately a year meeting obligations on time, consider applying for a secured credit card and use responsibly to demonstrate rehabilitation. Most negative information falls off your credit report after 7 years. Focus on reestablishing positive payment habits now. Old debts may resurface, so proactively contact collectors offering reasonable settlements. Finally, credit builder loans or secured cards tied to savings can also help strengthen payment history. Poor credit might seem hopeless, but taking ownership of your score, combined with financial discipline, over time can unlock new beginnings. We've covered substantial ground demystifying the credit code. Now you understand the key factors behind your influential 3-digit score, what goes into calculating it, and practical tips for taking your score to new heights. Healthy credit equals financial options, so monitor your reports routinely and direct money behaviors toward positive scoring factors. With consistent effort, you can leverage your credit score to open doors for the life you desire. Our financial reputation reflects our money truths. Here's to credit clarity and money wisdom.